Well, good evening, everyone. I'm glad you guys had a great day. So, I'll be teaching you guys basic market structure. So, I like to keep this simple as possible so you're able to understand what basic market structure is. So, let's start. Basic market structure. So I'm sorry I wasn't able to make videos of this sort because I was pretty busy in school. So exams coming up. So I had to, study for exams. Still not done yet. So basic market structure. We're talking about the direction of the market, where you see the uptrend, the downtrend, the expansion, which is also called consolidation. So let's understand the concept of the uptrend. In a market where you have a higher high, a higher low, another higher high, higher low, higher high. This is considered to be an uptrend. Let me mark it so you can see. It is considered to be an uptrend. Why? Because it is continuously creating higher highs and higher lows, higher highs and higher lows, a higher high here, a higher low here, another higher high here, higher low here, like that, like that, like that. That is why it's called an uptrend. So, that being said, the downtrend is the opposite of this uptrend now. So, you need to see this, but not moving up, but moving down. Sorry, my network is pretty bad. That's the reason I'm not even able to create some of these videos because I'm still in school and the network here is quite frustrating. So bear with me. So this now is a downtrend example: a lower high, a lower low, a lower high, a lower low, a lower high, a lower low. So this one now is an example of a downtrend. Let me write it. Downtrend. A downtrend. Why this is an example of uptrend, also called bullish market. While this, let me give it space. While this is also called a bearish market. So the reason we call this uptrend or bullish market, we all know, is because of the highs, the lows, the highs, the lows. Where the word bullish comes from is from the bull. If you've watched some of these sports the cowboy does, like the one in a ranch where you see a rider on a bull and he's trying to balance himself while the bull is still jogging up, like the bull is trying to lift him up, trying to get him off his back. And when he successfully pushes the rider off his back, he tries to use his horn to toss the person from the ground up. So that's the reason. That's the reason we call this market a bullish market, because it's moving from down to up. It's moving from the ground to the top. So it's moving from a lower point to a higher point. So it's moving from here this point, that's why it's called bullish, because it's similar to a bull. That goes for the bearish or the downtrend, which is called the bearish because of the word bear. This one, bearish, is bear. The bear, as the name implies, if you watch geographic or these animal documentaries where you see a bear trying to bring something down from a tree, it will climb it will just stand and try to shake the tree to bring it down, to shake, or it will even fall the tree, or to even climb something with its claws to bring it down. That's the characteristics of a bear. It brings something down. That's why it's called a bearish market. You understand? So it's characterized by a higher point moving down, the market from a higher point moving down. That's why you have this low, this lower low, lower high, a lower low, a lower high, a lower low. So let me mark it for you. Let me do it. We all know this already now. This is a lower high, this is a lower low, a lower high, a lower low. So the market will not move in a straight line like this. Never. You won't see the market move in a straight line like this. It doesn't happen. So we need to see a push, a high here. Then the market should retrace, giving us a low, and continue breaking this high, creating a new high, creating a low, still push to create a new high, making this high the last high, that is the previous high, creating a new high, which is this one. Same goes with the downtrend. The market is going down, creating lows, this low, creating retrace to just to retrace, because you won't be going down all the way. It will retrace, it will make a move up again, then it will come down, breaking this previous low, that is creating another new low, which is this one, and retrace, creating another low, which is this one, breaking this previous low. That's how you know it's continuing a downtrend. That's how you know the market is still going down. If it is unable to break this low and comes here, you won't tell me the market will still go down. It might move from here now and go up. You understand? It can move from, instead of going down here, it will just start going up here and continue creating a trend like this. You understand? Creating higher highs and higher lows. You understand? So when you want to confirm it is still creating lows, it's when it breaks this low and creates this low and continue in that direction. That's how you know you are still in a trending market. So I will show you another example, because market moves in three phases. I just showed you the first phase, which is the first phase, which is the uptrend. Then the second phase, which is the downtrend. So now we need to move to the third phase. The third phase is accumulation or expansion, where the market doesn't move in a definite direction. So it's something like this. Just just moving within a specific channel. It's just moving within a zone. It's not creating any highs or any lows. It's just moving inside a channel. So this is a trend. We call it a ranging market. It's ranging. It's not creating any highs. It's not creating any lows. This one is called accumulation. Accumulation or consolidation. It's called accumulation or consolidation because it's not creating any highs or any lows. It's just there. You understand? It's just there. So this is the third phase. This is the third phase of the price movement. So we are not expected to trade when we are seeing this. I won't advise you to trade when you are seeing this because it's not a definite movement. You should trade when you see this and the uptrend, not when you see this. You want to trade here. No. Because it might just break. It might just from here it might go up, or from here it might go down. You understand? So it has no definite direction. It's just expanding till you see a break. Then you determine the direction of the market. So these three examples, these three illustrations or definitions, let's go to the normal charts, like the real chart, so you can find this in a real chart. So the pair on your screen is GBP USD, a 1 hour chart. This is a live trading analysis. Wow, my trade is going well done. So this is a live trading analysis on GBP USD. Now, what do you see? Look at this place. Look at from here now. What do you see? From the example I showed, or from the definition I showed of a downtrend. So you can see this is similar, right? It's similar because it's moving from a higher point to a lower point. It's moving from a higher point to a lower point, from a higher point to a lower point down here. So you know that the market is bearish. It's just simple as that. The market is bearish. You are not supposed to buy when the market is going down. That's what I told you. How is it moving? Now, look how it's moving. Because it's a 1 hour chart, you need to expand it so you will see it clearly. You understand? You need to expand so you will see clearly. Now, what do we have here? Let's draw it out. This is a low. This is a retracement. This is a low. This is a retracement. This is a low, a retracement, and a low. Now, with that being said, with that being said, you know how the market moves now. If you look closely now, you see it's a downtrend, similar to what is here already. You understand? Similar to what is here already. Is a downtrend. Now, when you can identify this trend, it will be easy for you to analyze your trade. Now, after the downtrend, what do you notice again? It's a very good example. This is now an uptrend. You understand? This is now an uptrend looking at you, because it's moving from a lower point to a higher point. Now, it's just clear. This is a clear example of an uptrend. Now let's analyze it practically for those who don't understand. Why is it an uptrend? Why do I call it an uptrend now? Here, let's start from this point, from the lowest point here. Price broke, creating a high here, creating a low here, created another high. Let me confirm where it created another high. This is where it created another high here, but it expanded, so I won't say it created another high here. So I will say it created this high here and created this low and pushed, gave us another high, but it created a short low here, which is also a low, and created another high. So now, if you see this move now, you notice it's an uptrend. It's a very nice uptrend. It's a very sharp uptrend. The market was going well, like it was going well is a very nice example of an uptrend. So now once you understand, let's give another example of an uptrend. We'll find a clearer example, a more suitable example of an uptrend. Now let's see. Here is an example of an uptrend. This one is very clear and very easy to understand. From a lower point, price gave us a high, gave us a low, pushed, gave us a high here, gave us this low, give us this high, give us this low, and give us this high. Now, what do you see? You are seeing a high, a low, a high, a low, a high, a low, a high. This is to tell you that it is an uptrend and nothing more. It is an uptrend and nothing more. That's just it. That's the example and pure definition of an uptrend. So, since we know the uptrend and the downtrend, let's go to a ranging market. Let's see if we can find a ranging market. Now, we have a ranging market. GBP USD is a very good example of a ranging market. Now, let me show you how you can spot a ranging market. Now, let's first analyze the direction of this trend. Let's first know the direction. The market started here. Look with me, look carefully. High, a lower high, a higher high. Because this high didn't take out this high. That's why I didn't point it out as a high. You understand? This high is higher than this one. That's why I won't count this one as a higher high, because this one is still above it. So till this one gets taken out, that's when you count the high as the higher high. But notice, it got taken out here. You understand? It got taken out here, but there was no low to it. There was no low. There was no low down here. You understand? So we will just count it as this, because where the market made a low was around here. So we'll just count it as this. You understand? Then the low, then the high. But as we got to this point, when we got to this point, what do you notice? What do you notice? Market was not making any lows. Like, it was not making any highs, any lows. It was just stretching. Like, when you carry a rubber band and you start stretching, market was just stretching inside a particular area. Look, market is just stretching inside a particular area. You understand? Because we don't know if it's going up or if it's going down. That's what I'm saying. This is where accumulation, consolidation comes in. This is called a consolidation phase. This is where you don't want to trade. This is where you don't want to find anything. You understand? Look at it. It's moving inside the channel until it broke here. It went up here. You understand? This is where the breakthrough came, till we made this big push to the upside. And went down, back. So you now trying to trade, you won't find any opportunity inside this place. You understand? Because you don't want to lose your money in a ranging market. Because the main essence of forex trading is to secure your capital, make profit, and manage your losses. You are to make profit and manage your losses. You are not to lose all your money in a particular trade. You are not to risk too much in a particular trade. You are to make your profit and manage your losses. So with that being said, your losses is not supposed to be higher than your profit. That's where risk management comes in. But we'll get back to risk management. This is just basic market structure. I'm telling you, this is just basic market structure where you get to see the uptrend, the downtrend, and the accumulation. With that being, if you understand these three concepts, you can move to the next. So With that being said, since we understand how the market moves, uptrend, downtrend, everything, my battery is low, uptrend, downtrend, everything, we can proceed to the next. So let's dive into the advanced market structure, because the market won't be easy as this. You won't be seeing this every time. Like, you won't be seeing this every time. You won't be seeing this every time. You won't be seeing this every time. You understand? So let's just proceed. Let's just proceed to the next phase. So I'm waiting for my network to restart, so I'll be able to move. I'll be able to proceed. I'm waiting for my network so that I can teach you the next thing. Okay, so the network has started. Let's get to it. Now, in the advanced market structure, let me give the heading. I hope you guys will be writing this down. I hope you guys will be writing this down because it's very good. It's very good if you like write it down so that you won't be able to forget. And even if you forget, you trace back to your notebook. You understand? Advanced market structure. So let's get to it. The advanced market structure. It's quite different. That's why it's called advanced. What we treated was basic market structure. That was basic. This one is advanced market structure. So now we all know the market won't be moving up, down, up, down, up, down. You understand? For us in this advanced market structure, because we already know the knowledge. You buy when it's low, and you make your profits from this move till market breaks this high and gives you this one. Then you don't sell from here to get this one because it is an uptrend. Same goes with the downtrend. You sell from here. You understand? You sell from the top, and you don't buy from here because it is a downtrend. What if you buy from here to catch this one and it just gets to this point and started going down? So you lose. You don't buy from a bearish trend. You only sell in a bearish trend and buy in a bullish trend. You understand? You need to follow the majority. When the majority is buying, you buy. When the majority is selling, you sell. That's just it. You make your profit from buying and selling. That's just the knowledge of forex trading. So let's get to it. Let's get to advanced market structure, shall we? So this is the advanced market structure. Now you have this trend, an uptrend. You understand? Highs, creating highs, creating lows, creating highs. Now, in an advanced market structure, this is what you see. In an advanced market structure, this is what you should see in an advanced market structure now. So pay close attention. There should be another block here. I'll teach you another block. For those who don't understand, I dropped a video on the group explaining what another block is. If you didn't watch that video, please do well to watch that video. If you don't understand, when I post this video, you react. After watching this video, please, the group chat will be open for at least an hour. Then you drop your thoughts. You drop where you don't understand in the chat based on what I'm teaching. Then I will try to make a video on another block so you'll be able to understand what another block is. So advanced market structure, this is an uptrend. So we all know this now is an uptrend. You understand? So that in mind, knowing fully well that is an uptrend, we have to see price coming back to that other block or area of invalidation, others call it POI, point of interest, you understand. Area of invalidation is where there was a big impulse or big industrial push, you understand, where there was a big impulse in the market, where the market moved with real ferocity. Let me use that word. Where the market moved like that the move was caused by big market movers, because we deal with market movers, you understand. So that impulse should be around here, or another block should be around there, you understand. So what will happen then? The market will come back to respect that place, because once there was a big impulse that made the market to shoot up to this point, certainly when it comes down, it should come back here and still shoot up. That's the concept, you understand. That's just the concept. So what will happen in an advanced market structure? We need to see the market trailing down from here, you understand, trailing down, then comes here and buys back up, you understand. So this is what we want to see in an advanced market structure. This is the basics. Now let me explain to you, let me explain something to you guys. So this one is called a POI. POI is also known as a point of interest, you understand. This is where you want the market to come back to, because this is where you want to trade, you understand. Then there must be a break of structure, you understand. This is called structure shift. Sorry, my network is misbehaving again. Okay, I think we're online now. So there must be a break of structure here, you understand, followed by another break of structure. But this second break, most times it doesn't occur, but it will still respect the setup. Then we need to see price coming back to take. This one is called a liquidity. This one is called liquidity, also known as money. Bear with me, please. My network. That's the issue I face here in school. So you guys should bear with me till the network restarts or comes back. That's when I'll be able to show you with my tools. So what I was saying is the price should be able to come back. Okay, I think the network is back. Let me see. Come on, man. Come on. So welcome back. Sorry, my network is really bad. So we were here though. So this one is called liquidity. Liquidity is also known as money. Where the money is, that's where price will definitely come back to. I would like you to draw this and draw it out on your jotter anywhere, because you'll be seeing a lot of this in the chat. You'll be seeing this knowingly and unknowingly. You will see it, but you will not know because you haven't been told. So what should they see first? We need to see this, a break, a retest, you understand, another break, price coming back, filling into the other block or FVG or area of imbalance in your POI and buys up. This one is a bullish scenario, you understand. Is in a bullish market, not in a selling market, you understand. This is where you want to buy from. This is where you want to buy from. Same goes for the selling setup. The market is going down, creating lower highs, lower lows. Then you see this, then it pushes down. Like with this push now, is like there should be an order block here, or an FVG, a fair value gap or something. So that's what you use to identify your point of interest, your POI. You don't just mark the POI. You need to find a strong level where it will make the price to come back, like to come back to that point and sell from there or buy from there. I will show you this on the chart. I'll show you this on the chart. So this is what I call this might be the type 1. This might be the type 1. I'll show you 3 types. Then we'll get to see those type on the chart if time permits. This is type 1 of the setup. This is type 1. So let's see type 2 though. Let's see type 2. So type 2 is like this, huh? We have this. Note, it's a bullish trend. You understand? It's a bullish trend. So type 2. This is type 2 though. Here is where you want to trade from. You understand? Type 2. Here is your POI. So here is your POI. Here is your liquidity inducement area. Let me write it so that you won't be using $sign. Here's your liquidity inducement area. So this is where price will most likely come back to, So this is your liquidity inducement area, and it needs to be taken out. It must be taken out. So what do we have here? We have we have let me break it down. So this is the setup. This is a ranging market, like a trending market. You understand? So price created highs, lows, highs, lows, highs, lows. Then now did this, came down, swept liquidity. That is, broke structure to the upside, not liquidity necessarily, but a change of character and a break of structure. Now it changed character here, switching to bearish. You understand? It was moving up initially, but it broke this low, switching the trend to a bearish trend. You understand? So after doing that, it now created a liquidity here and broke structure again, breaking the low, telling you it's still moving bearish. But what happened? Those people that will sell from here now will not exit. They will think it's still retracing. They will now be taken out when it moves here, tap into this other block here. You understand? And sells. You understand? So we are supposed to make money from the sales there. You understand? We are not supposed to buy, we are supposed to sell. Now this is where you most likely enter from and catch the trend down. You understand? So this is the sell strategy. It's similar to the ABC. If you look at the group icon, you see this. You not see this type. You see the first type. It's similar to the ABC, where we have the A. You understand? You do understand? The B and the C, because this A leads to this B. Now this B must be taken out. You understand? The B must be taken out. Price must take the B out. When price takes this B out here, it will now push down to this point. You understand? So that's how the strategy works. It's called a QML pattern. It's called Quasimodo pattern. is very notable in the chart. We call it the QML strategy. It's a very nice strategy when you understand what you're doing. When you go to the chart and you look for patterns like this on every time frame, a higher time frame, lower time frame, you understand? You find it there, you wait for your confirmation and you enter and you profit off the market. It's as simple as that. So let me give you the bearish, the bearish scenario. Now, sorry. Now, here is the I gave you the bearish scenario. Sorry. Here's the bullish scenario. So, in the bullish trend, we are supposed to see a downward movement. In a bullish scenario, that is the setup, we are supposed to see a downward movement followed by a bullish movement. So, assuming we are going down, we're trailing down, then we broke the low, this initial low, then we pushed up, breaking this structure here, gave a liquidity inducement here, broke structure again, come back to tap into this FVG or area of imbalance or an order block here. You understand? An upstream order block here, which will now make the markets to push up again, breaking the structure up here. So that's just it. That's what we are looking for in the market. That's just what we are finding in the market. That's what we just want to see. We just want to see this in the market. So this is the type 2 setup. This is the type 2 setup for the QML pattern. You understand? Okay, this is when my network started loading. This is the type 2 setup for the QML pattern. Let me write it. Type 2. Type 2. This is the type 2 setup. This is the type 1 setup. This is the type 2 setup. You understand? Please draw it out and try to study it. You understand? Draw it out and try to study it so that it will stick. You understand? So let's move to the type 3 setup. If I'm not mistaken, the type 3 setup. Type 3 setup. Okay, let's go. Advanced market structure, type 3. Right. Okay. Assuming you have a bullish trend. Understand? Okay. Assuming you have a bullish trend. Market comes down. Broke structure again. Comes down here. So this is more like a confirmation pattern for a sell. If you flip it, it will be like a confirmation pattern for a buy. So we have to find an FVG here, POI or area of imbalance. You understand? The market was buying, but it switched to bearish. This is where you call a break of structure. This is what we call a break of structure. Let me write it so you'll be able to see. We call it BOS. We call it BOS. A break of structure. You understand? Structure shift. Then price will tap into there and sell. So we have to enter the market here. I'm sorry. We have to enter the market here and catch the profit. Stop loss will be above this high, and we profit off it. Same thing goes for the buy. We have to enter and catch it. If you notice, it's quite similar to this one. Only that we use this one. We use this one for confirmation. You understand? It's also used as an entry model. You understand? When you see this, when you see this one now, it's similar to this one, but we use this one as an entry model. You understand? So that's what we use it for, not necessarily for anything else. We just use it as an entry model. So with this type, there are other types which I will discuss later in other videos, but first I would like to see your reaction. It will make me to make more videos educating you on strategies that I personally use. You understand? I use these strategies and it works for me. I have a decent win rate and it helps me to get 1:3 risk to reward, 1:2, 1:4, 1:5. So with that being said, I would like to go to the chart so that we'll get to see this one live, this setup live on the chart. So you're able to identify them on the chart. So let's get it. Still my network still misbehaving. Okay. Let's get it. Let me flip it. It's still inverted. Now for this trade, we can see which setup is this. If you all know, which setup is this? Let's find out which setup is this. Is it the type 1 or the type 2? Look at it carefully. Let me flip it so you can see which setup is it. If I can flip it, I don't know. Let me see. Which setup is this? Let's see. Let's mark it together. This is a high here, right? This is a low. This is a low here. Then this one here. Then another low here. Then this one here. What are we expected to see? The market coming down, creating another low here. Now, with that in mind, which setup is this now? Which setup do we see here? With that in mind, is it not this type 1? Is it not this type 1? It is. It is the type 1 setup that we see. That's why you mark this place. And here is the liquidity. Here is the liquidity inducement area. Here is the liquidity. Here is the liquidity that must be taken out. You understand? It must be taken out. This is a live trade. I'm trading this on my prop account currently. So this is a live trade. I've already entered the trade. I'm just watching it. So this is type 1 setup. In clear term, this is type 1. Now, why do I trade here? Because there is an area of imbalance here. Like I said, area of imbalance is where the price dropped, but it didn't come back to retrace. It didn't come back to fill in that gap. Now, if you look closely, you'll notice there is a space from this wick of this candle to this wick of this candle. You understand? There's a long gap between them. Now, what do you expect price to do? Because this space must be filled up. This space must be filled up. This space must be filled up. Because price cannot leave any space. So it must fill up this space. So that being said, if that space must be filled up, price would definitely now is filled up already now, because if you mark your 2 from this wick of this candle, you see is already filled up, and is even an order block. This thing is another block because it is a nice push down to the upside. Price struggled here and dropped, so it's another block, and it's an area of imbalance that price has filled in. You understand? Price filled this imbalance here. So after filling the imbalance now, what do I need to enter this trade? Because this imbalance does not qualify only for me entering the trade and profiting off the market. What do I need to see also for me to enter the trade? This is where the entry model that I taught you just now comes in. This entry model here, this one here, this entry model here, where you want to sell, you look for entry model like this. When you want to buy, you look for an entry model like this. So now, what am I doing? I'm selling. Yeah, I'm selling. So what do I need to see? An entry model that says sell. Now let's drop down to a lower time frame. 5 minutes. I use 5 minutes because 5 minutes is where you get to see an entry model. Now what do you see here? What do you see here? We have let me mark it out because it looks scattered, right? That's when you're familiar with your charts, you understand. We have this, a high, a low, you understand? A break of structure here, you understand? Then a sweep of degrees. Now the break of structure, the BOS here, a retest here, you understand? We're testing the other block, which means price should continue going down. Now, you understand? Price should continue going down. Now, let's bring this out so that we'll see. What does it look like? What does it look like here? Is the entry model now. Is the entry model. Is the entry model I was telling you about. Is the entry model I'm telling you about. Look at. Is the entry model. The sell. This is your confirmation. This is what made me to enter the sell. This is my confirmation. You see, after doing this, what happened? It spiked. The market closed just now. This I'm telling you is very recent. Is just now. Look at the time. Look at the time. It's just 22:51. If you're using 12 hours, this is just happening this night. So it dropped, and it should continue dropping. It should continue dropping. I'm expecting it to drop up to this low, and if it doesn't, fine. I'll just get my 1:3 and I'll leave the market. So this is what you need to see in the charts. This is just very simple. If you don't understand, come back to this video, watch it over and over again. You get to understand. You understand? Look at in the higher time frame, we still see the same setup. We still see the same setup. Sorry. We still see the same setup. What do we see here? We are seeing this pull down, price creating an inducement here, comes back down, because of this impulse. This is called an impulse, industrial impulse, market movers push. Like when a big industry comes into the market to buy something, this is what you get to see. You just see a big spike to the upside or to the downside, either way, and it taps into the area of imbalance. What happens after it taps? It started selling, creating another sell setup inside this sell setup. It's creating another similar, the same thing inside here. Now, what do we see? This one, you understand? This one, an inducement. This one, are you seeing? Are you seeing? Then this one. Then we are supposed to sell continuously. You understand? We are supposed to sell continuously. That's just it. It's just as simple as that. It's just as simple as that. That's just what we need. That's just what I'm looking for. You understand? When I go to the chart every day, I want to see something like this. I want to see something like this on a chart. You understand? It's just easy as this. Now let's go to another example. Let me take you guys to another example. The recent trade I entered, Nasdaq US 100. Let's go. Let's go. This one is in a lower time frame. Let's see, 15 minutes. This one was in a lower time frame. So let me switch to 5 minutes though. Let me switch to five. Yes. Okay, now let's see. This one is quite simple and easy to understand because we know already which type of setup is this. So the market was going up. Yeah, if you can see, was going up. Or let me just, sorry, let me mark here. Let me mark here. Okay, the market was going up because it came from here now. Yeah, this is one. This is the low. This is the high. Note, it didn't make any low initially. You understand? So everything here is liquidity. Everything here is liquidity. You need to confirm the low after breaking this low. When did it break the low? It broke the low here. You understand? So let's mark here now because this is where it broke the low. Here. You understand? Created this one, made another low. Then what happened? It now pushed up, tapping into this area, this level, tapping into this level. You understand? And when it did, what happened? It sold. It sold massively. You can see the sell, like it was too massive. You can see. Now, this one has liquidity. But I didn't mark out the liquidity because the liquidity did not come after the break. Where is the liquidity? If you want to know, this is a different type, but I'll show you this one. This is another type. This is another type. Let's mark it out again. A high, a low, a high. Now, this liquidity, this low, this one, another liquidity. It's called the double top liquidity. Then price broke structure here. Then took out the liquidity here. You understand? Then sold off. You understand? So this is called a double top liquidity. Let's keep it. Let's keep it. Now, where are we supposed to sell from? From this point, there should be an imbalance there on FVG or an order block. In this case, there was an order block there. You understand? Then this one is the liquidity that needs to be taken out. You understand? This one is the liquidity that price needs to clear. It needs to clear. It needs to go. Then it will sell. You understand? So that's how it is. That's how it is. That's how it is. That's just a simple example. This one is similar to type 2. This one is similar to type 2. But in this case, it didn't break structure before creating. It created inducement liquidity before breaking the structure. You understand? It didn't break the structure and created the liquidity. It created the liquidity after. No, it created the liquidity before breaking the structure. That's just it. That's just it. It's simple. It's simple for you to understand. It's simple. You can see it. You can see it. Let's mark it so that you understand more. Low, you see high, then liquidity. You understand? Then it now broke. Then it struggled. You see, struggling, reached there, and it dropped like pin. You can see the way it dropped. Self, look now. It dropped massively. After dropping, what happened next? It started moving up, creating his own highs and his own lows. You understand? That's just it. That's just it. There's nothing to it. There's nothing to it. It's as simple as that. It's as simple as that. So this is one example. I will show you another example before I will end the video. So let's see a type 2 example, a suitable type 2 example. The pair loading now is GBP USD, Great British Pounds versus New Zealand dollar. That is GBP USD. So let's go to 4-hour time frame. It shows on all time frame. You notice the one previously was on 5 minutes. This one is on 4 hours. Where you spot the setup, this is where you get your entry, you understand? So let's start from, I'll teach you this one. I'll teach you this one later. This one is not part of what I'm teaching you now. So that one will be next time. So what do we see here? What do we see here? Is it a type 2 setup? Yes, it is. Now let's mark it down. Where is the market coming from? Low, a high, a low, a high. The market broke. You understand? After creating the low, you expected to create a lower high, then continue going down. Is that not so? But what did he do? He now broke structure here, changing the trend. He now broke structure, telling us that no, it's not going down again. This is a confirm. This is a clear sign it's not going down. How do we confirm it's not going down? He came here, gave us inducement liquidity. Look at inducement liquidity. A liquidity here. After creating a liquidity, he didn't take out this one. That's why I tell you, it's not all the time to take out this one. He just came in, tap. You understand? Came back again, to just tap again. It was not ready to, come down. Then after coming here, for the second time, it now tapped into the area of imbalance or order block. Now, I will show you this one is a clear example of an FVG. Then what happened? He bought, like the buy was too massive, you understand? The buy was too massive, like it was a massive buy. It was a massive buy. Which example is this? Which example? If you know, which example is this? Tell me so that I will know. Wait, which setup is this one? I'm seeing the setup here. Oh, I didn't enter it. So, which example is this? Which example is this? Which type is this? Is this not the type 2 we're talking about? This is a clear example of type 2 setup. You understand? This is a clear description of a type 2 setup. Now you see it happens in every time frame. It happens on all time frames. You understand? The 1 hour, the 2 hours, the 30 minutes, the 40, and so on and so on. Now, what did he respect? He respected an order block or FVG. It's an FVG, a strong FVG, because an area of imbalance. Now, why is it an area of imbalance? Look at the space. Look at the space here. Look at the space, like the space from the candle, the space from this candle. You understand? There's a clear space, like nothing happened here. Price did not come back to this level. You understand? You understand? And this level is also called a protected zone. This zone is also called because the amount of money that the market movers put into the market, you understand, to push the market up in order to break the trend. The amount of money they put here to push the market up in order to break this trend, you understand, there is so much that here is a protected zone. Because of why is it a protected zone? Because the market came here like this, and push up immediately. So here is a protected zone. That's why it's called a protected zone, because the market will not disrespect the zone so easily. You see, it's not disrespect the zone so easily. And after creating that, it didn't come back to scatter it. It created liquidity, went up, came back, took liquidity, tapped into this level and bought. You understand? You understand? So now let's see on a lower time frame. Let's view this. Let's view our entry now on a lower time frame. What made me enter the trade now? Let's know what made me enter the trade. I know you guys will be eager to find out. Let's go to a 15 minutes chart. Because when you want to find your entry, you won't use the 4 hours because your stop loss will be wide. So you need to go to a lower time frame and find your entry so that you know where to put your stop loss, and it will be, you manage your risk and all that. So let me show you what I saw before let me take this one out first. Now, what made me put my what they call it? What made me put my entry? Now, the entry was not so sharp, but irrespective of that, it gave us a nice entry. So let me take this one out also. So here, what do we see? What do we see? The market was coming down here. You understand? Highs. No. I'm sorry, I'm coming. The market was coming down here, created a low. Push, gave us this high. Give us this low. You understand? Give us this high. But it is just the week. But the let's just mark it. Then give us this low. You understand? Give us this high. Give us this low now. You see, it swept this low. Immediately after sweeping the low, what happened? It pushed up, broke this structure. You understand? Giving us this high, this higher high. Now, the same thing we see in the 4 hours is now occurring in the 5 minutes inside the POI. That is how you know your confirmation. The same thing that happened in the higher time frame is now repeating in the lower time frame, telling you that yes, they are aligning. Higher time frame and lower time frame are in agreement. What happened? He pulled back. After pulling back, started buying to the upside. This is the model I told you we use for confirmation. Let me bring it out so we can see. This is the model I told you we use for confirmation. Where is the model? Where is the model? The sweep of liquidity. You understand? The break of structure and the retest of that break. The retest of that break. Where is it? See now. It's just it. That's just it. That's just it. You go to a lower time frame and you find this. That's just it. Simple as. It's just simple. This entry model is the same model on a higher time frame. The same setup you are seeing on a higher time frame repeating on a lower time frame. You understand? On a lower time frame, when you see this, you just need to enter. You just need to enter the trade because it's clear. Higher time frame and lower time frame are aligning. Now, what happened after that? He pushed up, giving us this sweet high. Most people could have made their own profits from here, at least 1:2. Then he came down, trying to give us another pattern. You understand? But I don't see this as another pattern. But what happened? The market, was moving slowly. It was sluggish around this area. I think it lasted for about 1 week before finally it started moving to the upside. It lasted for like a week or so before it started giving us a nice push to the upside that we have up to this point. I would say. So that's just it. There's nothing to it. It's just finding the setup, waiting for your confirmation, finding the same entry model on that lower time frame and executing. executing. I'm going to teach you guys this so you're able to spot it. When you're able to spot it, then I will teach you risk management. Because when you know this, you need to know the risk management. You need to know what you're supposed to risk. You need to know how to manage your account. You need to know how to manage your profits. You need to have a nice psychology. If not, you will not be profitable. You understand? There's one thing that you know the chart, you know how to identify a setup, you understand, you know all these things, but you're not profitable, you understand. This is another example of the type 2 setup. This one is a clear example, like it's very easy. You can see it. I even marked it. You can see it. Here, market was coming down, sweep, a break, a retest, this and you have it. You have that move. Like it's as simple as ABC. Basically it's ABC, but it's as simple as ABC. You understand? This is what we look for in the market. And when you have it, this is a buy to sell because I already analyzed. No, my network is out. I'm sorry. This is a buy to sell because I already analyzed this setup, the buy setup, which is which is this one, the buy setup. Then I discovered that there's a level up here that price will likely respect and come down. What is that level? It's the FVG. Now, it's the FVG. You understand? Let's get to let's get to see it. What is that setup? Is the FVG. Now, what is the FVG? This is FVG. You see that black long candle? Let me zoom it for you so that you see. It's a 4 hours chart. For you to see this black long candle, to tell you that industries, big market movers entered the market around this point. That is why you see this black long candle coming down. And what does this mean? It's an area of imbalance in the market. The market is not balanced. You understand? The market is not balanced because look at the gap. I keep telling you, look at the gap. From this last candle, this last blue candle, to this one here, you can see the space in between. The space. This space needs to be filled up. You understand? Market needs to come and fill that gap. You understand? So what happened after market came there to fill the gap? It dropped, which is here. You understand? Which is here. It dropped. Look at now. After it came there to fill the gap, tapped into this FVG. It tapped into this FVG. You understand? And it dropped. And it dropped massively. Look at now. It dropped massively. Straight down to the downside. After dropping, it still came back up there. You understand? It still came back up there. Let me show you where it came back. That's why I marked it to the future. So that when it will come back, I will still remember. Because it will now use this place as liquidity. It will now use this one as the liquidity. You understand? Because this place is the area of imbalance. It's the nice imbalance because there's still gap. Look now, there's still gap from here to here. There's still empty space that price have not tested. You understand? So what will happen when price comes there? It will still drop. So what happened as the price tested that area of imbalance? Look at now. Look at what I'm telling you now. Look at the space. Look at the space. What happened after it tapped there? Eh? It dropped. Look at it dropped massively. Look at massive drop to the downside. It's as easy as this. When you study for some time, you get to understand this. No one will tell you, you understand? They won't tell you, you study. And I'm doing this for free. Normally I'm not supposed to disclose this for free because I didn't learn this thing for free. I paid a lot of people which they taught me rubbish. But the one I really appreciate and I'm thankful to God for was Dax. He's not a musician. He's just he's a forex trader. Dax. Is you follow him on Twitter, which is X, Telegram, and what do they call it? He's on YouTube. So I watched some of his videos and I learned a lot. I learned a lot, you understand? And it made trading to me easy to spot this setup. Look at how clean is this? Just look at the sell, the buy, the sell. It's just so clean. It's just so clean. You can see now. No long walk, just clean as it is. You understand? So I hope you guys will come back to this video and tell me your thoughts. Anything you don't understand, you message me directly. And please, I don't want any other message which is not concerning trading, please. So you message me directly. When I have time, I'll do the video, and I'm sure I'll have time to do the video, and I'll drop it for you guys, so you guys will understand. You know, we need to make this thing as easy as possible for everyone, so that they'll be able to understand. Remember, positive mindset. Just put your mind to it that you want to learn forex to, like a new skill. It's not a get rich quick scheme. You understand? It's a process. You need to study. You need to understand the process. When I started forex, I was not doing anything right. Let me just tell you the truth. I lost a lot of money. I was not doing nothing right. I was ignoring everything that I would know it, I would do it without learning. But I lost a lot of money. Then I said to myself, no, no, it's not this way. If those people that are making profit like this, they're doing like this, they won't be making profit. So I had to some point bend down and learn, starting from beginning, from the fundamentals, market structure, movements, candlesticks. You understand? Entry to where I am today. Thankful to God, I know all this thing. You understand? The main goal is to learn the skill. To learn the skill, even if you don't have the capital, just learn the skill. When the capital come, the skill is already there. You understand? The skill is what matters. When you know your skill, you just have to get the capital and know you just need to apply your skill, your knowledge, you understand? And you make money from this. That's just it. So I would like to see you guys' reaction on this. Tell me anywhere you don't understand, like anything you don't understand, and I would like to explain it. If you need to learn more about my strategies, and you need me to mentor you on anything, I'll gladly do so when I have enough time, because like I said, I'm still in my exams, so it will be hard for me till after my exams, and I'll be able to do more of these videos so that you'll be able to understand. I know you won't get it at the first time, so when you practice it over and over again, you get to understand it. That's it. Thank you all.